So in this video, I'm going to show you one of the biggest wealth strategies that are completely hidden in plain sight, and it's about small dividends. See, most retail investors are so busy chasing high dividend yields, they completely overlook the big tech companies that have small dividend payouts, or they look small, but a lot of investors do not see the real potential. You know, when they look at these large big tech companies, 20 cents a share, they wouldn't get out of bed for it. You know, what's the point in that? I want big dividend yields. And I'm going to show you the math behind how important even just a small dividend yielding portfolio can actually be used. And the math is fascinating. What I'm going to do is use Lombard loan rates of like 4 to 5%. Now, this is on IBKR. I was using 5.14 and 4%, but these could be less. Lombard loans with certain private banks might do base plus 0.5 or 0.25 depending on the portfolio. So I'm using the higher end of the cost. This applies to margin loans, security-backed line of credit, Lombard loans. They're all the same thing. And all I've done is I've put together a portfolio that's yielding 0.75%. Now, most investors would say that's useless. I can get 10% on private credit. I can get real estate REITs yielding way higher than that. Obsession over the yield, not realizing what it can do. So let's look at this. Now, I've just used high quality big tech companies here. This isn't a particular portfolio, okay? I've just threw these companies together because the point of the video is to show you how effective these dividends are. So the majority in this one is Microsoft, because out of the big tech, it is the slightly higher on the dividend. So look here, it's $1 million portfolio. Now, the math is the exact same if you take off a zero. Take off 2 zeros, it's the same. Add a zero, it's the same. The math doesn't change. That's not what the point is. But look here, how much dividends this person is getting, this investor portfolio is getting round about $7,500, 0.75%. Now, what do we do with this dividend yield? Well, investors who are afraid of debt would do nothing with it. They would just allow it to accrue and build up. But a savvy investor would use that to cover the cost of their Lombard loan or their margin loan. And then you start to realize, what is the actual cost of the debt? Well, look at this. If we borrow 15% of the portfolio, $150,000, the dividend is covering 97% of the loan payment. So the actual cost to the investor's portfolio per month is $19.24, or $230 a year. So at the end of the year, they look at the debt and it's $150,230. It's almost as though the debt is fully covered by your assets. And this is what I always talk about in earlier videos. The biggest objection people have, of course, to buy, borrow, die. The two biggest fears, margin calls, number one, and number two is how do they pay the debt? Because they view the debt as something that they need to pay, like a car payment or a mortgage. But wealthy portfolios view debt as a tool to buy more assets. And that $150,000 could be used for a lifestyle event, or healthcare, education, vacation, anything. Or you could go up to 20% on this portfolio, and the dividends are covering 72% of the debt payment. So it's a $233 a month payment. Now, I say payment, but remember, these loans are capitalized onto the portfolio. So all that happens at the end of the year, at the end of the year, or the end of the month, it goes to $200,233. It's just added on. But we've got a growth portfolio. So keep in mind, I always get asked about, can you use dividends for buy, borrow, die? But I always know these people are chasing high dividend yields because everyone does it, not realising that a very small dividend effectively makes your loan potentially free in a sense, because, well, you might borrow less and the dividends cover all of it. Now, keep in mind, these big tech companies have a strong track record of increasing the dividend every single year. So after 3-4 years, the dividend covers the full loan interest. Now, this is obviously heavily weighted towards Microsoft because you were getting the growth as well. Now, obviously, at the moment of making this video, Microsoft reported earnings and it was positive, and it's up 16% today, which is very good because, look, a lot of people believe that big tech companies are too big, they can't grow. It just goes up 16% on a positive earnings, and it can easily cover dividends, and most importantly, it can cover buybacks. Buybacks are equally as important as dividends because not only do you have the dividend payment covering the cost of the loan, you have buybacks increasing the value of your shares. Yeah. This is the strategy of dividends. Not chasing, the super high dividend yields because you're going to pay more tax. So that was on a 5.14%. Yeah, that was a high rate. I mean, that is a high rate. This is in a high interest rate environment. People thought this strategy was dead when rates were hiked. It's not. And your equivalent interest rate as well is 1.4%. We haven't even talked about inflation. Yeah, so, okay. 1.4% your annual rate. We have the two types of inflation. CPI, the cost of survival, and M2, the cost of power. Whatever metrics you want to use, the actual true cost of the loan is negative. I've used CPI inflation at 2.5%. So the debt is eroding. M2 inflation, if I use that, which I use, the debt is negligible. Negligible. Now in this portfolio, what if it wasn't such high dividend? It was 0.5%. So less Microsoft, a little bit of Meta, Broadcom, Apple, Nvidia. Okay, all high quality companies. That's the most important part is high quality companies, super strong balance sheets. They can raise prices. Yeah, your dividend is only as good as the company. The company's ability to generate cash. So yeah, this one's got $5,000 a year in dividends. Again, most people would scoff at that and turn away. That's why this strategy is so hidden in plain sight. And look, again, it's still covering 65% or 50% borrowing the 200k. $435 a month capitalized. Capitalized is the most important part because so many people view this, the civilian mindset is just, this is a payment. I have a payment. Consumer debt is bad, but this isn't consumer debt. This is the cheapest debt on earth. Now, if you're a sophisticated investor, you could get that even lower. You could use a box spread if you're confident in that, or you can contact brokers, private banks. Now, if the rate was at 4%, there you go. Your debt coverage is 63% on 200k, 85% on 150k. You get the point. It gets to a point where, the debt is so cheap. And there's the 4% yield. True cost of the loan, 1.48%. If the yield was 0.75%, I mean, the 150k loan is completely free. On a 200k loan is $43 a month. I mean, if people, if you said to a retail investor or a civilian, a person in the street, you can get a loan of 200k for $43 a month, they would be confused, Now, of course, margin call. This is a good time for me to make this video because, South Korea have just been margin called 1 in 30 adults been margin called. The prodigy investor, the Leo Breschner, he was like a ex-8 OpenAI. He's been liquidated entirely because he was over leveraged. He had a $20 billion portfolio liquidated to zero. He was borrowing 75% of the portfolio, and he was using risky companies, not blue chip giants. Yeah, so the portfolio would need to crash 70 to 80%, which has not happened in market history with these sort of types of companies. I know there's a lot of numbers in this video, but I also wanted to show you margin of safety. Imagine two investors, right? You're investor A, you bought that entire portfolio at today's prices, and I'm investor B, I paid $100 for every single one of those shares. Okay, imagine I bought all those companies years and years ago. Does it make a difference? It does make a difference, but more for the psychology. Both of us actually have the exact same margin call threshold. We're both borrowing 20%. So we both have the same margin call, whether you paid today prices or I bought the stock 20 years ago. However, I have a psychological margin of safety as well, because when the portfolio crashes, this investor A portfolio is actually seeing unrealized losses, whereas this portfolio is still in the green. So they literally feel nothing when the market crashes 30%. They feel absolutely nothing. So it provides psychological safety, which is why your margin of safety is so important. Yeah, it's virtually impossible because these large cap companies would need to go to like a single digit price to earnings. Wall Street would have to sell the stock through immense buybacks because they're sitting on all this cash to buy back the stock. It would be extraordinarily difficult. And most importantly, what are you actually doing? What are you actually borrowing? Because what happens if someone just saved up the dividends? You're buying time. That's the most important thing. It's time. You're getting the money today. Whereas the other investor who is afraid of debt because they've been institutionalized by, the society, they would save up those dividends. It would take them 16 years. 16 years to save 200k just from that portfolio. Both investors' portfolios are worth like $6 million in 16 years, and I've used 12% growth just as an example. But of course, the person who saved for 16 years, their cash is worth less because of CPI inflation, M2 inflation, whereas this person decided to pay the $246 a month to get the money today. And finally, taxes. Who pays more tax? The person who chases the high dividend yield. That's taxed at ordinary income, potentially $37,000 a year, depending on that person's tax bracket, versus the person who has the smaller yield, pays $1,400 a year as an annual tax bill, far less. Now, I'm not an accountant, but I'm sure you could maybe offset the interest of the loan. I haven't checked that, but I'm like 90% sure. I'm sure your CPA or your accountant can figure that out. Point is, that's the cost of doing business, cost of owning the assets. You can't stop a dividend. It's part of owning the stock. But how amazing is that? I found the math is fascinating. Percentage math is fascinating, and that's the way to do it. That is how we structure a Lombard loan where it pays for itself. I will be putting my spreadsheets. I know I've been saying this, but I'm working on it. On Beehive, I'll put the link in the description. Submit your email. And if you want to email me, you can. If you're interested in getting a Lombard loan, you want introduced to like a broker in London, I can do that. You can email me if you're serious about doing that. I'll forward on you to a broker who can source private banks, Swiss banks, and hopefully get you a competitive competitive rate, and of course, execution only, because we don't want to be paying asset under management fees. I hope you found this video useful.